Hi, everyone. Welcome to the Mortgage Heroes Weekly Podcast. I'm Andy.
Will.
Hey, you know what? We got to stand in. Brian, you can stand in for Will today. He's gone again. He was back for like one show. He's like, I'm back. And I'm gone again. Yeah. He's like a magician or something. We're going to get right into it today, Brian. So the first article we're going over today is from CNBC. The salary of a family of four that needs to get by in every U.S. state, it's more than $150,000 in the most expensive one. So there's a whole list here, okay?
This is concerning.
All 50 states. So I'm going to start with California because we're in California. So let's just talk about that one really quick. It says the California annual income needed for a family of four is $138,357. Now, that is in fourth position. There are three other states that have a higher annual income needed. In Connecticut, you need $139,924. In Massachusetts, you need $150,578, and New York, $139,504. Now, most people will go, "Oh, New York, it's $139." Well, New York City, yes, is baked into the New York number, but like New York has a lot of perimeter. There's a lot else to the state of New York than just New York City. But I think it definitely tilts it higher on that side. But I mean, check that out, man. There's California coming at the number 4 spot, and 3 that are higher. That's nuts.
I was looking at the list of all of the states, and what stood out to me is that out of the 50 states, there's only 10 states of which are under
okay, good
$100,000.
Isn't that nuts?
And it's not like 60K. No, it's like 98. 90,
no,
88.
90. 96.
Look, it's under 100,000. But come on, now you just rounded up.
Okay,
You're right
look,
there.
96,000, 90,000. You got 98, 95, 94. Let's see.
Okay.
97. Yeah, 96, 97, and 94. Yeah, 88. Exactly. So
It's still on the high end.
this is a reflection of a ton of data.
Yeah.
Right now, this is representative of all these states, which is, I understand there's like a statistical variance that it's going to be inaccurate to the upside downside by a certain percentage. Every number's like that. This is just really us facing the truth and the seriousness of what affordability looks like in America right now.
Yeah.
And at least when it comes to these that are listed, I think I said something wrong. I took Hawaii. I'm sorry, I missed out on Hawaii. Hawaii is at 147,000. So California is actually 5th on the list.
How can we
not
forget
4th.
Hawaii?
Sorry, Hawaii is actually 5th.
Sorry, Hawaii.
Here's what's also interesting. Of the places that could be the most expensive, I guess if I was to like just immediately go out without looking at all this, I would have thought it would be like Hawaii or New York number 1 and 2, and then everyone else, but like Massachusetts number 1. So
That's what I thought. In the Connecticut too, I was just kind of like, what's going on over there?
Well, because it's proximity to DC. So
makes sense.
same thing with Massachusetts.
That makes sense.
So I think
East Coast.
I think it's that. Yeah.
Interesting.
So in Mississippi came in the bottom. That's what you're saying. The 88,000. I mean the point of this little exercise here is that the cost difference really comes down to housing. It comes down to housing and it comes down to taxes.
Yeah.
So as cited in the article, the cost difference between states is largely due to housing and taxes, which can be as much as 3 times higher depending on where you live, especially if you reside in a major city like Los Angeles or New York, San Diego.
Yeah, we're
San Diego.
We're in
I
there
mean,
now.
there was an article. Was it last week or 2 weeks ago? We're talking about like these highest priced median price per square foot, and San Francisco was not on the list.
Surprisingly,
that was weird, right? So just as much as this one saying, yeah, so it might be as much as 3 times the high because of places like L.A. and New York. San Francisco is commonly thought of as one of those places, but even that article a couple weeks ago, it was not. And in this one, they're not referencing San Francisco, but it's California as a whole is the point.
And what I think is just crazy is that, $88K a year is basically what you need for the cheapest state. But on average, people don't even make that.
Well, that's the thing. I mean, let's see. From the research group Motio, it says basic expenses for a family of 4 in all states exceeds what most U.S. households typically earn, which is estimated to be a median $78,171. So that means everyone earning above that and below that, the exact center point is $78,000.
That's a mortgage payment depending on where you buy for the whole year.
Hold on, that's crazy.
That's exactly what I was trying to drive. That it's like I'm working with clients. They have a fixed salary of let's say 65K. that's just gonna pay for the mortgage.
Dude, okay, hold on. No, keep talking. I'm gonna do the math on this.
Yeah, exactly.
Okay?
So when I had some clients come in, it was 3, 4. It was a family of 4, and they basically, they're like, "Hey, so we want to buy a house, but we don't know whether if we're able to buy it on our own, like each one of us, or if it's best that we all buy together." And one of them made 45, the other one made 55, and the other one I believe was around like 61. Case being that they came out combined income of 160 if they put all their incomes together. Now, if they were to buy separately, none of them was going to get approved for anything because of the fact that their DTI was too high and the mortgage payment was essentially basically their whole salary for the year.
Okay, so I did $70,000 exactly. I chopped off that 171. So if you use 78,000 divided by 12, it's $6,500 a month. Look at that. $6,500 a month right here. Now, you were saying they make their combined income's what, 161?
It was 162. I think it came up to 160. Let's just say
that's fine. Let's just do 160 for easy round number's sake.
Yeah.
So divide that by 12. That's a gross income of $13,333. So 6,500 into 13,333 is 48%. Oh my gosh, so 48%.
I mean, and that's pre-tax.
Yeah, that's gross.
Yeah,
so we're talking gross numbers. That's gross.
That's gross.
That sucks. I'm sorry.
It
I'm
does.
laughing because I'm uncomfortable that that's just the state that we're at. I mean, it's hard because it's what we do, and yes, here in San Diego. And again, I have to qualify this because it's like there are a lot of people that we're helping that are active duty military or they're veterans and they are getting some sort of financial benefit because of their veteran status.
Yes.
That's helping them afford to stay here in San Diego, buy here in San Diego, buy and sell here in San Diego, or keep the place they already have. Because of the cost of living adjustment for active duty military, it means that people are still qualifying here in town, which if you're not active duty military, that makes it harder for you in some senses because that means you have to have an equivalent income to stay here and compete when that money is coming in tax-free on the BAH side. Not that it's not bad. I'm just saying that's what you're competing against. So this just continues upping the ante for staying here in San Diego.
And even if this is what you need to be able to afford a place in these states, you still can only use 50% of it, 55, depending on what product you use. But I think it's just insane because, like you said, I don't want to sound like like I'm laughing at it, but at the same time, it's just so obscene that this is happening because it's like, yearly salaries are being paid for mortgage payments and living.
Yeah, I mean that's like you and your wife being married. And like, okay, one of us is working for the house, and the rest of us, one of us is working for the rest of our life.
Paying,
for the rest of our monthly expenses of our life. Yeah, it is also I think notable because so many of the states, like you mentioned at the beginning here, are above 100,000. I mean, I
think that's just ridiculous.
Well, and in some places like. Okay, here's one that I was surprised by. And maybe you can share one or two that you're surprised by. Like Missouri. Missouri, $101,000. Like I was honestly surprised Missouri was over $100,000.
Nebraska at 106?
I know. And again, I'm not saying this because I think those places are terrible or they suck. I'm surprised by it because it's all look at Wyoming, 101, Wisconsin, 112. You have here's another one. You have Utah, I kind of understand. Pennsylvania, 115. Ohio, 104. North Dakota, 101. North Carolina, 104. I mean, and it's just everywhere.
And for us being here in California, we think, California is the worst. California is the worst. And you start looking, you're like,
well, and this is family of 4.
Yeah.
What about a family of 5 or a family of 6 or a family that has a senior with them? That's more expensive as well.
And that's also very true.
I mean, this is still just a family of 4, right?
And price points in other states are significantly lower than here in California, but you're still needing this amount of income to be able to get into those properties.
Right, but I mean, dude, Indiana 102, Iowa 105. These are not places that I would have thought coming into this part of our conversation. A lot of these Midwest places, I would not go, oh yeah, that's going to cost over $100,000 to raise a family of 4 anymore. But they do, but which makes the point that we've been talking about this year is like the prices have gone up, they've stayed up, they are not easing off, they're just slowing down. This whole there's like a retreat of inflation is just they keep saying it in incorrect. And I don't want to say they're doing it on purpose, but they're not doing it accurately by saying that inflation is going down. When it's not going down, it's slowing its growth. That is very different, and this is what that looks like.
Yeah, and I also think that they do that on purpose just because they can't just, give such a good outlook and it not happen. So they also have to, I feel like, at a certain point, be able to, kind of mask themselves and say, hey, like, well, this is just, this could happen, but it can't happen. If we assure people that it's going to happen,
Well, okay, I get that. The actual math problem here, though, not the actual. There's numerous problems here, but the one I want to make a point about is that the income being unable to keep up with the rate of the cost to have a house that size. That is the real issue. Is that if it's running ahead of you so fast or so frequently and consistently compared to your income, which is maybe is inconsistently going at that same rate, you're just going to be chasing it forever until you make a change. Either reduce your debt, add income, get a side hustle, do a second job, start a business, something else. And, we see a lot of people doing that, of course. You even see articles coming out now, and we don't highlight them here on the show, but when I'm looking for show notes, I'm looking for articles to talk about for us, I'm seeing more and more articles about retirees going back to work because their retirement plus Social Security, not just Social Security. Their retirement plus Social Security isn't cutting it, and they have to go back to work. And I'm going to tell you this. I was at Walmart the other day with my wife, and we were checking out, getting our groceries, and the nice gentleman, his name was Michael, at the cash register, he's like, I'm not from here. He's like, I'm not from here. He was from Montana. And he goes, I'm here because I have family that lives here. He goes, but I had to come out of retirement and get a job so I could afford the rest of my life to live. Oh, God. So he's like, my retirement wasn't cutting it. And we're just at the cash register. I don't know this guy. He doesn't know me. And
he's just like, hey, buddy, this is my life.
But look, he was older. He was easily in his later 60s. Okay. I don't think he was in his early 70s. He was very much in his later 60s for sure. And he was just talking about I have all these hobbies. I love, going out to the wilderness. I like rock collecting and, all this other stuff. But he was like, I can't do it. And so, that's why I'm here. I hope you guys are having a good day. I'm having a good day. I'm just making the most of my situation. I'm like, dude.
And I mean, I can only imagine how much countless other stories are like that people are just literally like having to do what they have to do to make just ends meet at the end of the month.
They're like, watch around when you and Michelle are running errands around town. Like, look at how many people who are, let's say, in that, I'm just gonna say the boomer generation.
I'm actually going to Walmart after work, so I'm gonna. I'll definitely see that.
And look, we're there frequent enough that you notice when there's like new faces.
Yeah.
And there's a lot of new faces around there, and they're older than me, bro.
And now that you started mentioning that, I do like recall that when I go to Walmart, there's a lot of older employees.
Yes.
Like, and it's like it didn't just hit until you said that right now, and I'm like, wow.
Yeah. Just take survey. Like, it's not just Walmart. I'm sure there's other stores as well. Of course. I'm thinking just in the labor force in general. I think part of connected to this whole family of four thing. It's in researching coming up for the articles for this show. I'm also just seeing a lot of titles of news articles talking about seniors that are having to go back to work because of the same issue.
Yeah.
It's just cost. So. Family of four, you got to be really making it somehow, or in a combination of ways, like you were talking, Brian, in order to afford, quote unquote, in each state to raise a family of four.
Or you could just have one of your kids become an influencer, and you could YouTube bunny.
What? Well, I guess this is on YouTube, right?
Yeah.
Just like a walking example of that. So
hey.
Let's move to the mortgage rates.
That was rough, man.
That was hard.
That was.
Yeah, it is. It's tough, but we have to talk about it.
Yeah, I know.
It affects what we do for people here every single day. They're walking in with the problem. We're trying to help them solve the problem, or at least get into a home with the problem they currently have. And it's just something we confront off camera, and so it's worthy of talking on camera. Okay, Brian, mortgage rates in the U.S. decline.
Hey,
I couldn't get through the title. They declined to a 2-month low of 6.875. I mean, look, that's good news compared to 7.25. But people aren't flocking to the real estate market because it's from
3.5,
6.9 to 6.8.
Honey, the rates dropped.
Like
call the loan officer.
Like losing their mind. Wow, go now.
Call Brian. We need a refi
now. The decline is just that. It's a decline. It is certainly not it is not like opening up a new basket of money where people are flocking back to real estate right now. Broadly, the people who are coming towards real estate still are looking at it for the long haul, like we've been talking. They're looking to have cash flow, whether it's investment property or buy a place that they can build an ADU on or something like that. And that is the type of buyer that we're seeing, where they're not only buying a house for themselves right now, but they're buying it for some sort of financial purpose later. And that is going to continue, especially when things like this are happening. It's like, the headline is mortgage rates declined ever so slightly. The decline is still a decline, so I'm not going to pull the rug and say it's not a good thing. It is a good thing. It's just not a great thing because it's still really far from where people have their golden handcuffs in the 3s and 4s. Being at the high 6s is great for people getting in now. Yeah, not so hot for people who have got their rate that's a lot lower today.
And one of the things that I like that they mentioned is that, with the rates staying at the levels that they are, one of the things that I wanted to, just clarify is that, just because rates come down doesn't mean they tank like 1%, 2%. But what rather happens is that it gets cheaper to get that rate or that pricing. And what
That's a good point.
What a lot of people don't understand is that when they hear rates drop, they're like, oh, rates dropped, like, oh, they're back to like 5-4%. But in reality, they're just dropping in the cost, because you also have to take into consideration that the lowest rate isn't always going to be the cheapest rate as well. Mm-hmm. So one of the things that I liked in the article that they said, make sure that you're cautious about where you're shopping for your rate and you're asking the right questions. I think that it's very important that you should ask for a rate with a discount, rate with no discount, and then rate with credits, so that all the ranges of what's available to you, and not just go with what they say that, hey, you should definitely do this.
Go explain that to people who may not understand what you're talking about when it comes to discount. Explain that kind of not the theory. Explain how it works so people understand what you're talking about, like the par rate, and then basically buying down.
Right. So for super simple example purposes, let's say the lowest rate that's able to be given to you today is 5%, but that's going to come at a cost of 1%, 2%, because the bank's saying, yeah, we can give you this.
You're already going ahead. 1% or 2% of what?
Oh, the purchase price.
Okay, let's say you have a $500,000 loan amount.
Yes.
And the market rate is 5%, but it costs you out of pocket or part of your closing costs 1 or 2% of that loan amount, which in this case would be $5,000 or $10,000 to get and secure a 5%.
Yeah.
All right, go ahead.
So let's say you take that route, great, you're going to be saving in the beginning years, but you also have to pay for that. Now, you can also say, hey, what is the rate at par, meaning that I'm not paying it down, I'm not, I just want to know what it is for me to get the rate at, which is going to cost me nothing. Then you'll see the difference. You'll be like at 5.5 to maybe 5.625 for it to be at a no cost. And then you also have the ability of saying, hey, well, I don't have all of my closing costs, or I would like some of my costs to get covered by credits or seller credits, whatever it might be. You also have the option of saying, hey, loan officer, is there any way that you could provide me with lender credits? One of the two things they'll say is like, yeah, we can take that 5.5 or 5.625, and if we take it up to maybe a 6%, we can offer you X amount of credits back so that you use for your closing costs. That in itself, I think, is a huge strategy, because a lot of people will say, hey, I got the extra 1 to 2%. I want a lower payment. Yeah, I'll pay for it. Or you know what? I'm strapped on cash right now. I'll take my par rate and refinance down the line. Or, hey, I need credits. I need help. I could take a little bit payment up in the beginning years, and then I'll refinance down the line.
Yeah.
But you have these options to be able to, minimize your mortgage costs, and more than anything, understand, what you can and can't do. And it also helps out with your payment and, your money that you're forking out for the purchase.
Yeah. So the idea of discount points is so that you can secure a lower interest rate than what the par rate is.
Yes.
And then in the case where the interest rate is higher than par, there's usually money on the table that can be applied towards your credit, your closing costs as a credit. So that's what Brian's talking about there. And for those of you who've never heard that before, as far as mortgage rates declining kind of in like this season of the year, it's summer. That's a good sign. You've seen inventory last couple months kind of creep up a little bit.
Yeah.
You see people getting out there again, especially in places where weather is more something you have to contend with across the country during the winter and kind of the fall coming into the winter months. So that is occurring. I know that they're saying people are gravitating back towards real estate, but what the differentiator is, they're going back towards places that are ready to go.
Yeah.
So it's like, if I'm going to pay this elevated price at an elevated rate, then the place needs to be done. Now, that leads people towards new development or newer homes, or homes that may be a little older, but they've been modernized, they've been upgraded, and they kind of look the way they would look now in the market, even if it was built 20, 30 years ago. You walk in it, and it looks like, it was kind of built here recently.
Yeah, and I think that's one of the things that people, start to realize, that is, if I'm going to be paying this much for a house, it better come with everything that I need, or everything that I want. And I do see a lot of people gravitating towards, new builds and stuff like that, because of the fact they're like, hey, well, I'm already going to be paying this much for a payment. That's an older house compared to this. I'd rather go into the new build. Now, that's not always, the best case, because there's also fees that come along with buying a brand new house. Like Melrose could be, above $1,000 just in that for property taxes. And then high HOA costs is that, tack on maybe another $500, maybe even, $1,500 in just, fees a month to your mortgage payment as well. So I think it comes to what the people really want. And if they want to transact right now, there's people that want to buy. Is just, it really comes down to the rate, this and that. But there's the people want to buy. People want to go out there and sell. I mean, unfortunately, the market isn't giving them the opportunities that they want. But the people have that want for wanting to sell their houses because they're also seeing that, I have a low payment, but I also have all this equity.
Yeah.
You know what I mean? It's like I got my $2,500 payment or $200,000+ in equity.
Yeah, there's a big part of this is like what are you willing to tolerate?
Yeah,
because I mean, it in the end, if you go to the 30,000 foot level, it's what are you willing to tolerate? If you're renting right now and you're tolerating a high monthly rent, and you're like, well, if I'm going to pay this much, I might as well buy a house. Well, then okay, I'm going to tolerate that high monthly payment on my mortgage.
Exactly.
Now, if I have golden handcuffs and I got to refinance at 3% a couple of years ago, and I'm holding on to that, well, you're not going to tolerate a 7 or 7% interest rate or a 6.5 or maybe not even 5.5. It has to be like you must need to get that money out of your house or something, and that's where the equity comes into play, like you're talking about. So
that makes sense.
Broadly, even back at your example at the top of the show, talking about the family where the combined income was roughly $160,000, the monthly payment's going to be $6,500 or whatever. It's like you have to tolerate that. that has to be like within your limit of accepting that as true for you, and then willing to continue doing things you got to do to make that payment.
So we recently just helped out a good friend of ours get into their house, and it was two brothers that bought houses. They work for the city, and combined same thing. I think there were around $150,000 for income combined. Same thing. They live together. My buddy has a kid, has his 2 kids and his lady that they live with, but they bought together. And the thing for them was that the payment is that $6,500 payment. And, right now what they did is they leveraged those credits that we talked about to bring the rate down the first 2 years and, ease into that mortgage payment in the beginning years of the mortgage. Now, that payment came down still to $5,400.
Hold on. Slow down for a second. Some people would be like choking right now.
Yeah.
Like, what do you mean it came down to $5,400?
Yeah. So we went from a rate of 6.250 down to the first year at 4.250. And still significantly, the payment was, still above $500,000. The purchase was, I believe, for $746. Came in with minimum down payment 3.5%. And to them, that was, it was a hard pill to swallow because they also weren't paying, their rent, I think combined was like maybe close to $3,100.
Oof.
So yeah, now having to double that payment when you're getting used to splitting that payment, and that's very, very easily digestible. Now you have to fork twice the amount to be able to, now own your property. But, for them, the situation, like I said, made sense. They needed more space. They just had a new baby. They have the brother that lives with them, and they also have a 7-year-old daughter. So, they needed more space than where they were at. They were at a smaller condo they were sharing. So they said, hey, we realize that our situation presents itself, and this is what we need. I know the payment's that, but what am I going to do?
Yeah, it's what it is.
What I mean? What am I going to do? And when I gave him a call, luckily he's like a really close friend that we grew up with, and it's still a tough pill to swallow because, the goal is going to be to refinance in the 2 years. But, in the beginning years, that doubt and that, like, who's giving you that peace of mind that it's going to happen, although we are constantly looking at the market and, we're going to reach out to them when the opportunity does come. But it's a bit frightening for, going from a $3,100 payment to now double that.
Well, yeah, but on the other side, you kind of like slid it in there. You're like, oh yeah, down to $5,400. Like down from what? Like higher than that, number one. But again, earlier in the show, a $6,500 monthly payment all in for this family. Well, $5,400 sounds a lot better than $65. Isn't that insane?
And it sucks because insane. It's like that's $1,000 back in your pocket virtually. So it's like it's still a lot, but
it's still 54 going out. Like
I know, but it sounds whatever way you want to put it. It's I'm gonna get cooked in the comments, but it's okay because unfortunately that's the situation of the reality of right now, and it sucks to say that hey, this is what it is, and I can't believe we're saying this, but it's the truth. We're writing notes at these prices, at these ranges, and
the only solution is more housing. The only solution is more inventory, more development, and I think we're going to see that. We have to turn that corner in the next 12 to 24 months. We just have to. Otherwise, we're absolutely squashing and killing the quote-unquote American dream for first-time home buyers because we're talking about the cost of raising a family of 4 at the top of the show. Now we're talking about mortgage rates still in the high 6s. Even if they're high 6s, mid 6s, low 6s, still in the 6s, fine. But again, at these same prices, with these interest rates, that's not helping people. It's keeping them out.
No, and it's unfortunate because the one thing that we're supposed to be doing, ramping up starts for single family houses or just multiple homes in general, it's really slowed down, and that's the one solution to a lot of things. And once our other problem of rates come down, it's only going to put more pressure on this problem because it's not happening as quickly as it should be. And again, it goes back to higher for longer because, one thing drops, but the other one's going to stay right the same.
Yeah. So let's talk about that a little bit. Let's talk about the U.S. single-family housing starts.
Yeah.
The article here is that U.S. single-family housing starts fell in May. Here's the problem with that. That's the single-family housing starts, not just the shelter at large.
Right.
Last week, we had talked and we had a segment about the multi-unit permits really high up. So they're on the incline. Single-family housing start permitting is on the decline. So they are shifting as far as the ratio of number of multifamily units versus single-family units that have permits being pulled. I think a lot of this has to do with the cost of building and permitting, number one. Number two, I think this has to do with cash flow for the development side and the investment side. And it really would, it makes sense from the business perspective that you're like, well, gosh, if I'm going to have margins over here with multifamily and I can sell more units at the market rate right now, or I have to have less margin, or let's say less sales with not as much margin in single family dwellings, then I'm going to lean towards a multi-unit. That just seems to be the way it's going.
And one of the things that I noticed, I feel that after 2020, when everything shut down, I feel people also want a place that has a lot more things, like a full community where it has like all your stuff, you literally like downstairs. And it also comes to the point where people, when everything closed, everybody wanted to get away from the cities and they wanted to stay away, get their house, like, oh, I don't want to live next to anybody. But then we realized that we as people need to be around other people because it's just, gives us life, gives us energy. It helps with your, with your mindset, with your mind well-being and all that. But at the same time, you start to realize, and I see a lot of different communities that are popping up, Millennia, over in Mission Valley, where they have basically everything. Yeah, that one's freaking that one's popular, and there's so much. When Will was sharing us that we went to go walk it, I'm like, where is that?
Dude,
like that's dope. It's like a little
awesome.
City.
It absolutely is.
It's like a little city. And to my point, that's what I feel. A lot of these communities that are multi-unit projects, it's like a little city that has everything within like a mile radius where you don't really have to go anywhere to get whatever you need, and it's all very accessible to you. And I feel that people a lot of times will trade accessibility and comfortability for paying it, being able to like I rather be comfortable and taken care of, and I'll pay for that because it makes me feel good.
Yes, and I think some of this has to deal with the business side, which we were talking about a second ago. What am I going to build to make margins as a developer? And the other part is just culturally. I think what's happening is in some of the younger generations, they're like, this is how we want to live. It's how we're choosing to live, and it kind of makes sense. I went to school a long time ago, Brian. I was in college many years ago. I've been out for a long time now, but you know what? I lived in a dorm. And I lived on a campus, and on that campus, I had all the things I needed. In my dorm, I had all my friends. I wasn't married, I didn't have kids. So there's a lot of differences, of course.
Yeah.
And before everyone gets all hot in the collar in the comments, like not comparing dorm life for your personal living situation, but there's some similarities culturally where you're like, you know what, this is just how I'm going to choose to live right now. And then after I left college, I went to a big apartment complex off the 101 freeway in L.A., and it had 1,000 units?
Yeah.
I mean, it was like massive.
It's like a hotel.
It had its own gym. It has its own parking lots. It has its own office, its own maintenance. I mean, just it's the stuff we're talking about and all this multifamily stuff we're talking about on the show right now in this season of life.
Yeah.
And, I think the surprising thing in the data is that the single family home is harder and harder to get right now than it was a couple years ago. In the graph we showed last week on the multi-unit housing permits, they are the highest they've been in 30 years for consecutive years. So going all the way back to like 1980, I think, like 32 or 34 years of data, the most multifamily unit housing permits have been pulled since 2020. 2020, 21, 22, and 23. And there has not been any year that has had that many ever up until that point. And so this is a trend shift.
And I was just noticing, like how long could we keep going up for, Like it needs to come to a point where we stabilize. I don't foresee this crashing because of the fact that the data is telling you right there's not enough houses. But there does need to be some sort of stabilization.
Yes, but it means single family houses are going to hold their value still.
Oh, of course.
Because there's fewer of them, and this isn't pointed out in the article, but I'll see if you made the same observation I did. It says that data for April was revised higher to show that single family starts rising to a rate of 1.036 million, which means 1,036,000 units. But if you go to the very bottom of the article, it says permits for future construction of single family homes fell to 949,000. So they actually are under 1 million for future construction, which means that the trend from the graph of the multi-unit family, the data in this article, and then the future construction is actually still going that way.
And they're telling us we're moving in this direction.
Yes.
This is what's working. And I feel that I don't know if it's working, but for them.
Whether it's working or not, it might be just part of economics. It's what people can afford to do. I can afford to do this in the multi-unit community, and I cannot do this on the single-family community. And if there's less single-family, if there's less numbers coming in the future, then that's going to secure housing prices.
Yeah.
So we're not necessarily. I'd say you might see that there's some solving happening in the market. It's just not with SFRs.
Yeah.
It's with multi-unit, not with SFRs. So
Yeah.
SFR prices are probably going to continue to hold, and we're going to continue seeing the multi, because again, the inventory is not absorbed. The demand for inventory is certainly not showing up in the market. So there's going to have to be a higher concentration or higher volume of units, a higher volume of new doors created in order to absorb all the demand we have in the market.
Yeah.
It's just not going to be SFRs. So last thought on that. Anything else? No, that's it. Okay. Well, here's why that matters. Guess what? We have the nerd part of the show, which is from CoreLogic. The homeowner equity insights from Q1 came in from 2024. Now, this is interesting because everyone saying that there was going to be a crash in house prices is currently still incorrect. We saw a $1.5 trillion increase of total equity volume in the first quarter of 2024 with elevated rates. This is so insane, which represents a 9.6% year-over-year change up.
And we're not even done with the year.
Up. That's in the first quarter, year-over-year. So we'll do a second quarter and third quarter with this summer season, summer buying season.
If it keeps the same, we double that, 18%, guys.
But here's the deal. It says CoreLogic analysis shows U.S. homeowners with mortgages, roughly 62% of the properties, have seen their equity increase by a total of $1.5 trillion since the first quarter of 2023, which represents a gain of 9.6% year over year. Haters be damned. They are probably seething right now that this continues. The crash that it keeps getting delayed. It gets getting delayed and delayed.
But I think at one point you just have to realize that you're seeing the data, you're seeing the numbers, and I just think that you just want to be right.
Yeah, no, of course. I understand. Well, because here's the argument. Yeah, a broken clock is right twice a day. Right? Okay. I've made that argument when it's worth arguing about something like that.
Yeah.
At the same time, though, this is representative of what we've talked about time and time again.
Yeah.
Even though the market interest rate is where it is, even though the house price is where it is, if you and me are out bidding on homes, and there's an investor also bidding on a home, how long are we going to hold our breath waiting for the price to come into the place we want it versus where the market has the price of the house at? Because the investor ain't waiting around. Investment purchases in 2023 were higher than they were in 22. And so far in 2024, they're higher than they were in 2023. So what's happening is the people that are in the game and have the cash and can buy the places are buying the places. And I'm not even talking about corporate-owned stuff. We covered that last week as well. I'm not talking about corporate-owned investments. I'm talking about 44,000 investment purchases were done in the first quarter of this year, which I think we extracted. So that's gonna be on pace for 176,000 investment purchases this year. That's 176,000 homes that are not going to the primary occupant buyer.
Renters.
Right. So, I mean, this is indicative that if you're in, you're winning, and if you're out, you're on the outside looking in. And unfortunately, that really sucks.
Yeah.
Again, this goes back to how do we get people into homes? How can we help them cross the threshold of home ownership and get in? Because in places like here in California, they are seeing the largest equity gain still, even though there has been a mass exodus for all the reasons you want to talk about, even though it's a very expensive place to live comparatively.
Yeah.
People are still holding on to real estate in California, and they're winning because of it.
I mean, if you can invest in California, you're going to have a cash cow. And although it is going to be expensive, you're going to thank yourself, as years progress, because you got an asset in a place where, I mean, you see the numbers continuously go up and it doesn't seem like it's going to slow down. So if you're able to identify a property that you can invest with, or, just get your foot in the door in a property here in San Diego, whether it be a condo, a small property or anything, you'd be surprised how many people just want a small condo as well. The demand is definitely there. You just have to be willing to take these opportunities.
Yep. And there's also a flip side of this coin, which is negative equity. These are homes that where the owner owes more than the current market value. So let's say you owe $500,000 on your house and it's only worth $450,000. That's pretty upside down. That's a 10% upside down. That's pretty bad. But again, there's situations like that. The national negative equity, as a result of home equity going up and prices staying up and accelerating again, the national negative equity has slowed and gone down. Negative equity by percent is down 16%. And by number, it is 192,000 homes that came out of being in negative equity. That is a lot of place. Think about 192,000 homes.
Jesus. We're back in green.
$192,000. Awesome.
We're profiting.
192,000 homes. That's a lot. I mean, think about you getting 100 buyers in. Okay, 100 buyers in 2024, and you still have 191,900 homes. So
where, please, we must.
Well, right. So the negative equity is a bad thing in general. The fact that there's less negative equity, like by a lot, is actually bodes well for the housing market in general. And again, reinforces that prices are going to be where they're at, and they're only likely to stay.
And this is coming from CoreLogic, so we know the numbers are crisp.
So kind of despite the person's loan balance and the reason they got there and all that, I'm not talking about notice of default, I'm not talking about foreclosure and all that other kind of stuff. I'm just talking about the balance relative to the house's value. You have seen a significant decrease for the better, in this case, of places across the country where there's negative equity. And when you look at the chart, there's actually very, very few places that have I'll say a lot of negative equity. And by a lot, I mean like 3%, 3.9, 2.4, 3.7, 2.3. That's what's considered a lot in this.
And if you notice, they also mentioned, but if homes were to go up 5%, a lot of those houses come back out of
especially in these places where the amount of homes that are upside down is like 0.1. Or I'm not 0.1, sorry, 1.1, 0.9.
They're one sales comp away from just coming right back in the game.
Yeah, and so it's kind of like, okay, so we're kind of like in this snapshot of this report. In the snapshot of the report, yes, 192,000 homes have come out of negative equity, which is great. Also, yes, if there was an increase, then even more would come out as well. This just is it's both things happening at once. Equity goes up, negative equity, homes in negative equity go down. In general, this is great for the housing market. Yep. In general, this also means that some people, by being able to kind of ride out the market, have maybe put themselves where they were at the waterline a minute ago, and now they're like this, like,
oh, okay, I can breathe.
All right, I got the waterline's on my nose. Now it's on my chin. And it'll be my shoulders and my neck.
Oh, wait, it's coming back.
Yeah, so as long as they can keep making their mortgage, so for those who are, still making their mortgage payments right now, they're not late and all that kind of stuff. This bodes well for you. This is great, and I'm happy that we can talk about some of this in a positive light because. Look, man, we live in a city that got absolutely clobbered when 2008, 2009 happened, and negative equity was everywhere. Yeah. Everyone was mortgaged to the hilt, and there were so many homes that came back on the market because of poor lending practices and all that other stuff that happened in the collapse. And for me, having watched that firsthand, being on the front lines, I'm actually really excited and happy that this is reflecting the way it is right now.
Yeah, I mean, it's really tough to go against not go against the market crashers because I mean
it's just not happening right now. It's not happening in quarter one. Well, okay, one thing before we cut out on this is that when you go to page 9, there was 2 charts on it. Mm-hmm. At the very top there, it says California, 64,000 of equity earned on average. Massachusetts, 61,000. Yeah, but where did you just see California and Massachusetts in this show?
Massachusetts was higher with the incomes.
The income it takes to raise a family of 4 in Massachusetts and California, both in the top 5.
You're saying it's cheaper to raise a family of 4 in California than Massachusetts?
That's
what the data says.
Well, you have Massachusetts making its second appearance on the show, which
shout out Boston.
Yeah, it rarely does that. But in this case, where at the top of the show we're talking about the average income it takes to raise a family of 4, they were on the list.
Look at this one.
Insufficient
data.
Insufficient data. That just means there's not enough.
Was that Nebraska?
No,
Dakotas?
South Dakota. So, it's no surprise that when you look at the loan to value ratio, that the higher the loan to value ratio, the better it looks for negative equity. The other way around. I said that backwards. But the point here is that the fact that houses continue to increase in price and in value is actually going to work for the people trying to get in the house now. Even though the prices where they're at, this still is a trend moving in that direction without without recourse at this point. And I know that if you've missed other shows, you've missed us talking about this throughout the year, I'll just kind of put a marker in the ground right now. I'll put a flag in the ground and remind you that there's an investor who's looking to buy real estate right now at the current price or maybe a slight discount. They're not just looking for the dog down the road that's 40% off. They're looking at the property they can get right now that has land that they can build on so they can get cash flow. That is why I really earnestly believe that in our inventory weakness, the investors are going to show up, they're going to continue showing up, and they're going to continue building out places, which means you're either going to get in or you're not. And that is the threat.
I can definitely account to that. This year, I've spoken to more investors looking to take wanting to do business and, get properties and take them down themselves more than any other year. And I want to say, and it's very refreshing because if the numbers make sense for an investor and they get their spread and they're going to be, profiting into the deal, it doesn't matter how much it costs as long as they're able to get their profit that they desire. And when I talked to an investor today, I was telling him like, hey, how's home prices in San Diego? Well, you're probably going to be, if you want a single family residence, you're probably going to start in the mid 700s. And start going up depending on the area. Yeah. And that's on the low end. And he's like, oh, that's not bad. That's not bad. If we're able to have that value that's going to be able to be, have that flip and turn around and bring our investment back, then I don't care what it costs. Yeah. I have the money to be able to invest. I know that I'm going to get my money back. So for me, it's really just identifying that the deal makes sense and I get my numbers that I want. Yeah. And that's, a lot of the conversations I'm having right now, and it just it goes to support that the investors are going to show up, and they've been showing up, and they're going to continue to show up because if a consumer's not buying that house, the investor already probably has like 2-3.
And then what does that tell you about the sentiment of the market? Like they're hot on real estate. So if you're not hot on real estate, that's fine, but there's a consequence to that decision. If they're chasing it down and they're saying, hey, real estate is where it's at, and real estate's where I can park my money, park my effort and my investment for 5, 10, 15 years, well, that means that should mean something. You got to look through the lines on that and go, that means that they're actually banking that the market's going to be healthy for that long too, and I'm not. So there's a disconnect there at some point. I'm not saying you have to agree with all investors. That's not the point. No. The point is that if they're seeing they're seeing benefits in the market now and a benefit to be in the market today for the future, then we ought to be looking at those same things for ourselves, especially if you're an aspiring homeowner.
Like, I mean, just to put it into perspective, like California gained $64,000 in equity since the first quarter.
Year over year.
Yeah,
since quarter one of 23.
Since quarter one of 2023. So that just means that the people that bought back then are now profiting.
They're up.
They're up from what they bought. And I could guarantee you that there was people in that position that were like, I'm not going to buy because I'm going to wait till it comes down. But it didn't. Yeah. And that's take that as an example that, you got to take that leap of faith, or you got to, make that decision. Or if not, you're just going to miss out on the train. But you just have to be firm on your decision. And truthfully, take the time to calculate the numbers. Reach out to people that that you can connect with, that are doing your deals, that want to do deals that you're doing them. Yeah. And really crunch the numbers, because you're going to realize that there's opportunities out there. You just have to be positioned very well. Yeah. Or just have people that can guide you.
Yeah. And I just think that's going to be, it's ultimately where the ball's going to land is in your court. Is like, look, I'm either going to do this or I'm not. And I don't say this to be callous or inconsiderate. It's just that there's a lot of things you can say, you can watch, you can do online, you can comment on, but at the end of the day, if you want to get into a home, you got to qualify. You got to get into a conversation where someone who's inside the industry can help you get across the line of home ownership, hand you the keys, and let you get and cross the threshold of your own front door.
Yeah.
We would love to do that. We do this all the time. But the reason I'm emphasizing this so much on this particular episode is because I do have the sentiment that there are people missing out. They have been missing out. And now there's more regret in the rearview mirror than opportunity at the windshield. And I don't want that for you. I don't want that for anybody who's watching us, who's connected to us. I want you to win, and I want you to be able to advance your life financially by real estate being part of it.
No, 100%. I feel that, there's those opportunities out there, and I feel a lot of people get misinformed by what gets thrown out in headlines,
Yeah.
and bad experiences. But in reality, there's a lot of people that I feel and I'm confident that are in a position to buy. They themselves just don't have that confidence, because they don't know what they don't know. They don't know how this works. When we closed on the house for my buddy, he's like, bro, this is what you do for a living. You have to make these calls. You got to do this. Like, he's like, dude, like, he's like, thank you. I don't know what I did. You remember you calling me, hey, this is what we're doing. This is how much you're paying.
Yeah.
And in reality, a consumer's just looking at it. How much is it going to cost me?
Yeah.
That's basically it. But they don't see what's going on in between. But I feel that there's a lot of opportunities if you take the time to understand what your options are, create a plan, or just get to know more information about what you're able to do, and you're going to bring a lot of light to your situations.
Well, and I think about it, like, so I'm over here, I'm typing away as I'm listening to you say this. I'm thinking, like, just in this California part of the show, it's like, okay, so $64,000 average of equity earned since last year gets $5,000 a month, $53.33 a month.
You just got paid $53.30 a month.
Just round down to $5,000. Your house has gained, let's say, on average, $5,000 a month. Like, if I just came to you right now and said, hey, you're renting and you have this place, and next door there's a place you could buy that you can afford to buy, and every month it's increasing in value by $5,000. Like, you can't say that about anything else. You can't say that about your watch or your car. I mean, look, I'm sure there's a couple $1 million, $2 million watches that maybe they increased to $5,000 a month. Maybe. Let's not go down that route. Okay?
Yeah.
That's a rabbit hole. What I'm talking about is the house next door that you are renting next to and you could afford. If that's going up by $5,000 a month on average right now, then at some point you have to decide, what are you going to do about that? Because if it passes you by and continues to race ahead of you, and you're in the same job with the same pay every month, then at some point that actually gets beyond you, and now you don't qualify when maybe today you do. Yeah. That's my final point. I'm not going to belabor it anymore. We need to wrap.
Let's do it. That's it.
Wait, what's the best part of the show today for you? What was your favorite part?
I wouldn't say it was my favorite part, but it was the most concerning and more like alarming. The incomes for all the states needed to be able to, afford a family for four.
Yeah.
I mean, a house for four.
Yeah. Got it. So for me, it was the equity insights, not because I'm a big dork and I like core logic. It's just those things they're very telling to me. I'm in a couple that with the single family housing starts slowing. Again, they're not declining, it's slowing. But going from above 1 million to the future contracts going below 1 million, that's actually a pretty significant number. Yeah. It'll actually have to prevail to be that, but that's the projection right now based on future permits being pulled. We're going to be under 1 million single family construction builds here, and that is I think that's going to be one of those things where you're going to see the headlines talk and the financial news and the market kind of channels go, oh, across a milestone, a big historic thing happened, and it's going to be that. So thanks, Brian. I appreciate it. I know we're talking about a lot of crazy stuff right now. Crazy difficult is what I mean. I'm saying crazy because I don't want to say the word hard, but it's difficult. It's really difficult. Some of these things are challenging. I know that people are sometimes watching and they're frustrated and they're really discouraged, but ask the questions and reach out and find out where are you actually at. What can you actually do to put yourself in a better position to get into a house like we help other people do, and we sit around here talking about all the time. So I want to remain solution-driven. Thank you for remaining solution-driven. And thank you all for watching, of course. So we're going to sign off today, but make sure if you have not checked out our Friends of Mortgage Heroes playlist, go see Brian, myself, and Will interview our friends in and around real estate. We have some great guests on already this year and some pretty fun ones coming up soon. Can't wait for those to be released. A lot of, I'll say, industry knowledge at the top of a big outlet that starts with a Z and ends in the illo. All right. I'm going to leave it at that. We'll see y'all again next week.
Let me know what you guys think it is in the comments. So, bye.